Hey everyone, this is John Feneck with the Feneck Commodities Report. With me today for our monthly is Don Durrett, founder of goldstockdata.com. Great resource for all investors looking for gold and silver research. And Don, welcome back.
Yeah, John. Yeah, another month, another interview.
Yeah, another lower price for all things mining. So it's going to be fun to do some of these in a up market because with Newmont downgraded yesterday, it seems like this is almost the low because you and I were just talking about Newmont on Friday, and we were saying it's going to be a cash flow generator at some point. And what are these analysts looking at this point? I don't get why they would even think about downgrading something like that at this point in the cycle.
Yeah, it kind of correlates with the current gold price and the current margins. There's just no expectations on mining doing well this year. The expectation is that 70% soft landing. I've always said that gold is kind of inverse to the economy. So if the economy is doing well, nobody cares about gold. Even though gold's at $2,000, I think even at that level, I don't think it really has a lot of interest with Wall Street, with investors. It's kind of odd that it's that high and it doesn't have much interest, but I think that's the case. I don't think there's very much excitement around gold right now, so they can downgrade it and nobody says anything. Because I mean, what do you mean? Nobody wants to own it. So if nobody wants to own it right now, so you downgrade it, it's like. It seems like it's more of a sentiment kind of indicator than, kind of the quality of, what Newmont brings to the table. 5.5 million ounce producer. I don't think their costs are really out of line. They're generating $1 billion in free cash flow, which is a lot of money. So if gold goes up, $100, the whole story changes for Newmont, like overnight. Just the $100 change, it just completely changes, which is amazing. So basically they're saying we don't expect gold to go up this year. That's kind of what that downgrade's all about, which is, it's typical Wall Street anti-gold mentality, I think, because I think a lot of people do like Newmont here. Buying the dip, buying it at $30 is a pretty good price. I mean, my target, is north of 150, so. It's a three-bagger, I believe. So it's I think it offers a lot of value here.
Yeah, and for listeners that don't know, it is the only large cap gold stock in the S&P, and that clearly isn't helping it right now. But interesting to note, also they beat earnings by 4 cents last week. The stock got hit on that as well. But when you look at the top 3 holdings in GDX, Newmont is number 1 at 12.8%. Then you've got Barrick, which is GOLD, at number 2. They beat by 6 cents. And then Agnico Eagle beat by 8 cents, had a really good quarter. And that stock is kind of bucking the trend, which is nice to see. But those 3 stocks alone represent 30.1% of GDX. So, a good quarter in my view from the big 3.
Yeah. Right, so let's kind of let's pivot a little bit and look at kind of what's happened here at the beginning of the year with gold and silver. So I mean, I expected the stock market to do well in January and February. I didn't think it would do well all the way through February, but I was very bullish in January. I just thought, it was going to 5,000. I was very confident the S&P was going to go to 5,000 after it went up in November and December. And so that, again, inverse to gold and silver. So if the stock market's going up and the economy's going up, it's been brutal. And the miners have been absolutely obliterated. So the HUI is down to 202 today. Mm-hmm. And as an investor, you know that anything around 200 is just a really, really brutal correction, if you will. I mean, 199 was the low in October, was the cycle low. So we're kind of all the way to cycle lows here. And the miners have been, we're starting to see, we're seeing the Newmonts. We're seeing a lot of these stocks are hitting prices that are opportunities. I don't think we're going to go much lower. I mean, if you look at some of the leaders, look at Pan American sub 13, you got Hecla, 375, knocking on the door at 350, 330, which are just really, really low numbers for if you're a long-term investor, which I am. And so, I see, this is, for me, this is the buy zone. It's hard to buy bottoms. So I like buying, anywhere sub 225 on the HUI, I like buying. So we're all the way down to 200. This is, a significant buy zone. You get below 200 on the HUI, and to me, that's really the time you just want to gobble up miners, is just get as many as you can get your hands on. That said, the economy is actually still hanging in there, and I mean, the Fed right now, if you look at the expectations on the Fed cut, they're not. Earlier, we thought they were going to cut in March or in April and May. Now it looks like they're not cutting. And if you look at the numbers, they're not going to cut until June. So the cuts just keep getting pushed further out as the economy does well. Now, the economy absolutely is kind of a bifurcated economy. It's not like everybody's doing well. The Russell's down 15% from its all-time high. So the Russell is really a better indicator of the economy, I think, than the S&P is, because the S&P is heavily weighted in the technology stocks, heavily weighted in these companies that are leading things. And the stock market is definitely kind of a one-sided boat where you have 10 stocks kind of leading the whole deal. So the economy is not, it definitely isn't hitting on all cylinders here, but it's doing well enough to keep gold kind of at bay. And I always said that gold's going to be stuck here until the economy actually rolls over, until the Wall Street basically finally gives in on the soft landing. Right now it's 70%, so they're not even thinking about giving in. So one final point, I think we're going to see a correction in March, but I don't think it's going to be a crash. I don't even think we're going to go down 10% in March, but I expect say somewhere between 5 and 10% in March, and then in April we're going to find out where the economy really is. Is the economy still going strong enough in April that the Wall Street, it just bounces? It'll be a short, shallow dip, if you will, and then we go higher, or we go back to 5,000. But I do think we're going under 5,000 here in March, and then we're going to see what happens. But we're really in this wait and see mode about the economy weakening, and it's hard to get excited one way or the other, really, because we're in no man's land.
Yeah, all good points there. I think, just talking about the Fed, when we recorded in December with US gold, if you remember, there was a 80 to 90% chance of a rate cut May 1st. So, March 20 was still on the table then, clearly like a 50 to 65% probability. But May 1st was in the bag, right? Like following the Fed December 13th, there was no question. And then, I looked Friday and it was a 26% chance of May 1st being a cut, to your point. So like, that's a huge difference. And I don't know why more people aren't paying attention to this, because if we have to wait till June for the first rate cut, there's a lot of companies that are susceptible right now, given their debt levels. And I'm not talking miners, I'm talking about outside of our sector, right? Like there's a lot of potential for problems. I think you still have Jamie Dimon, CEO of the largest bank in the world at Chase, saying about his own sector that it's unhealthy, right? Like, I mean, no one cares. I've never seen an environment like this where people aren't paying attention to smart people in respective sectors where they have strengths, right? Like, I don't have all the answers, neither do you. Like, we listen to other people, our peers sometimes, right? Because we like to learn as we go along. We have open minds. I think most people are momentum chasers in this market, and they're just chasing what's hot. I mean, I don't even know how to put a valuation on Nvidia or something like that at this point.
Right. So I'm going to pivot outside of our normal stream of focusing on current macro, because we're in kind of this wait mode. I've been a writer since 1990, and I focus on the future. So I do a lot of research trying to understand where not just the United States is going forward in the future, but where the world's going in the future. And so I've been doing this for a long time. And
Sure.
I've come to the recognition that the probability of change being basically dramatic over this decade is like well over 90%. It's like, in other words, we're heading into an era, if you will, of really rapid change. And I think this started in 2016 when Trump was elected, and it's just picking up speed. And this all dovetails into the economy because the economy, in many respects, the U.S. economy, it's changing. Like you said, the banking sector right now is very weak, probably weaker than it's probably ever been, if you will. It's going to be hard. The changes that are coming to the economy over, say, the next 12 to 24 months, I think are going to be shocking because I think the changes that are coming to the U.S. and the world are going to be so extreme, if you will, that nobody's expecting it. I mean, I really think by the time we get to the end of this decade, we'll look back and it'll be a new world. We will not be living like we do today, which is really hard to wrap your head around. But it's just
Sure.
extreme change. And a lot of this is the financial system. So the financial system is actually going to have to be rebuilt in many respects. And so the U.S. economy right now, when you look at kind of the dynamics around it, I don't think investors really acknowledge that we're going into a new paradigm, a new normal. People think that, for instance, this so-called soft landing, the 70% soft landing. I'm telling you that's total baloney because you can't have a soft landing going into this type of change. It's just not going to happen. And so
Right.
12 months from now, people are going to go, what just happened? There's going to be changes in all aspects of life, and this is really when it begins, because the economy is everything. I mean, that's how we basically live our lives. It's all revolves around the economy, and so when the economy changes, it's going to impact our lives dramatically. And so I see this, everything that's been building, if you will, since 2008, 2009. When the Fed basically started manipulating the economy and started expanding the money supply and using liquidity and manipulating rates, all of that is basically it kicked the can down the road for 15 years, and now I feel that the debt bubble has actually popped, and right now the U.S. government is stuck in this fiscal dominance where they cannot cut spending, they have to have large deficits, they're forced to. Those large deficits are requiring the bond market to buy these huge numbers of bonds, $100, $200 billion a month. And so that is going to overwhelm the system. We're getting away with it right now, but we are approaching a point when the bond market cannot basically swallow all that money. There's not going to be enough buyers. And when we hit that point, that's going to be when things really start spinning out of control. So I just think this idea of a soft landing or this idea of a new normal is not going to happen, and that gold and silver are going to benefit in some way. Now, I don't know how much. I'm very bullish, but it's hard to predict exactly how much they will benefit. They're going to benefit to a certain extent, and that's why I'm excited about it. But I just wanted to bring that up because I just think that this is the year when things really start to kind of spin out of control, if you will, by the end of this year.
Yeah, and how do you feel? I mean, this is a question that we can't answer quickly, but maybe you could just acknowledge yes or no that you think that this is something relevant, because I'm seeing, Trump being the leading Republican candidate here, getting fined hundreds of millions of dollars. This isn't like a slap on the hand. This is a shift, and now that DeSantis is out of the race and Haley is faltering, how you could see Trump as being sort of a pariah to me, like where he, this is just getting really interesting in an election year right now is my point. I'm not saying Democrat, Republican.
Yeah.
I'm simply saying Biden has got a crappy, really bad approval rating, and Trump is firing on all cylinders against the odds. Yet he might not make it to the finish line if this keeps up, because we're talking like $500 million, I think, already.
Right.
Like, I don't know how much one person can withstand, right? It's like pretty interesting stuff.
Yeah. So remember, I basically said that I've been studying this stuff for, since 1990. And so this is all stuff I kind of expected to happen. So I thought
Okay.
that the economy would actually falter first. And then by the economy faltering, that would create change. That would create political change and social change. But it's actually the economy is the last thing to fall. So the first thing to fall has actually been politics, right? Our political system and our social system. Those are the first two things, but those are kind of the omens, right? Our political system, it started fragmenting in the 1990s. Newt Gingrich came out with his Contract for America. That was the very beginning, because that Contract for America wasn't for all of America. It was only for a subset. The Democrats goes, what about us, right? And so that started creating this fragmentation, which has now reached an extreme level. And now the Democrats and the media is kind of aligned with them in 2016, and you can see this total, it's like, what's happening to America, right? So now you have two groups of America. You have the Republicans on one side who are trying to hold on to basically the old way of life, the conservative way, the Constitution, and basically kind of not change, if you will. And then you have the progressives over on the left who basically want to create a new America. And they want to create they want to create a new America in their image, right? So you have these two groups who have different ideas of what America should be. Well, wow, that's a big problem, right? There's no meeting in the middle because they have different agendas. And that was kind of the signal, uh-oh, we're in trouble, right? And then you had COVID, and COVID appeared, and then you started seeing the institutional problems we have in this country, which was a big shocker, really. But those problems were always kind of festering, if you will. But now we're seeing it. It's like now we don't trust our institutions. We're like, oh my goodness, where's America heading as a country? And now the economy is the last shoe to drop. So those were precursors, if you will. And if you really look at them, you go, how do we overcome those? Because there's not going to be any solutions, right? There's not going to be any solutions when you don't have when you can't come together as a country. So somebody might solve one problem, but then there's all these other problems that nobody's addressing. And those other problems that they're not addressing just keep getting bigger, bigger, bigger. And so we basically have reached that point in time. We've reached that point in time where the economy's finally going to kind of go through that same, basically, that same type of change, if you will, because the Fed has been in control. If you go back to 2008-9, the Fed has been in control since then. The Fed has been able to maintain basically the economy, 1 to 3% growth. It's been able to do it. It's had the tools to do it. Well, now it's kind of they're losing control of those tools. But Wall Street's in denial. Wall Street believes that the Fed can lower rates if it wants to. It can print money if it wants to. This is an assumption. And so we're going to find out by the end of this year that the Fed has lost control. The Fed can no longer do what it wants. It's going to be very similar to what happened in Japan in the 1990s when they lost control and they couldn't get any growth. Now, they didn't get any inflation, but they couldn't create growth. They were basically in a constant recession for like a decade. They would grow like 1% and they would go negative 1% and grow 1%. They basically did everything they possibly could to create growth, and they couldn't do it. Now, if you look at the Japan's stock market, they finally got back to an all-time high. However, if you go back, this was all the way back in 1990. So if you adjust it for inflation, it's been 30 years of inflation. Yeah. They're nowhere close to where they haven't gotten back to a new high. So
I just wrote about that in the newsletter, actually, about that 1989 Nikkei situation where you had that blow off top and then a decline and then another run at the top and then a failure, and it just lasted.
Yeah.
And so Yeah, so you could look at similar charts like the 1929 into the 30s, and look at even 08, 09, and they were all similar in that they had those blow off tops, which we haven't experienced yet in today's world. We're still creating that blow off top, in my opinion, and then we're going to see, you know, like you said, maybe a 5 to 10% correction, and then another run at the top, and then a failure. But this time, the failure is going to be massive because we've just gotten so ahead of ourselves in some of these equities.
Yeah, 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 and it's been a Potemkin economy. It's a false economy. It's all been based on manipulation, not on true capitalist growth, if you will.
Right.
Mispriced assets with low inflation, low rates. And then you had China giving us cheap products, which helped us. It made, it made our standard of living go up because we were getting stuff for so cheap. I was at Walmart the other week, and now you can get a 40-inch TV for $300. I mean, things
Right.
are. It's like what? How come everything's so cheap? Because it's not built in this country, right? So all that, the globalism, it benefited us to a certain extent with our standard of living, and then technology in the 90s, that helped the productivity, which kind of boosted our economy. But bottom line is, everything, the easy part's gone. The easy part, that might be the wrong terminology. The conditions they no longer exist for America to basically be this dominant economy, if you will. We no longer have the global reach that we had. Now we have the global South that's bifurcating. The U.S. economy, the U.S. is now under pressure. The U.S. dollar is under pressure internationally. Things are going against us. The Middle East, the U.S. is definitely losing control in the Middle East, where you have Iran and Saudi Arabia now buddying up. That's kind of our worst nightmare. The last country to fall is going to be Turkey. We lose our alliance with Turkey, and we're just, we have nothing in the Middle East anymore.
And don't you think that's a possibility? I mean, Erdogan has been all over the map in recent years, and he's been outspoken about not getting into NATO, and he feels like the redhead stepchild to me. So that whole situation bears watching. We've been writing about the Middle East even before October 7th in our newsletter because we just think there's continual issues there that have now been exacerbated by what happened October 7th. And most recently, in between our last two interviews with those 3 casualties on the U.S. side, where the U.S. just lit up certain targets right after that to just basically show people we're not going to put up with this. So it's going to be really interesting to see how this plays out. Why don't we pause it there and bring on Alex Scanlon with us to talk about Barton Gold today.
All right.
Hi, Don.
Hey, Alex.
Hi, John. How are you guys?
Hey, Alex.
Very good. Thanks for joining us today.
Yeah, thanks for having me.
Sure. So Alex is CEO of Barton Gold. I learned about Barton through Don, and excited to hear an update from you and maybe an overview for 8 to 10 minutes about the company and what's happening in your view for 2024.
Sounds good. What I'll do is I'll bring up our corporate presentation and just kind of run through a bit of a refresher and an update based on some recent upgrades that we've had. And
Great.
Sorry, I'm going to cancel. Get back out of that. Now, can you guys see my screen there?
Yes.
Yes.
Perfect. Great. So this is actually a photo of a high-grade open pit that we have. So I'll come back to that. But one of the big pieces of news for us was that we recently upgraded our resources again. Coming into the end of the year, we had a really, really large drill program. We upgraded resources again for the second time. So we're really hitting a lot of pace and momentum, and at a very high level. Who we are and what we do. We are an Australian gold developer, so pure play focus on gold, pure play focus in Australia, and we're really focused in South Australia. This is the home of the Gawler Craton, a globally renowned geological domain. And what we've done is establish a strategic position where, in parallel with the copper belt that BHP now owns, this is the home of Olympic Dam, there is a 130-year-old high-grade gold producing district where we have gone in and consolidated every significant historical exploration and producing asset. And we also acquired the only mill in the region. We've now stepped back and we're actually building a much, much larger resource base so that we can take this sort of sporadic history of high grade and establish sort of a more significant large scale base of production. We've just recently taken our resources to over 1.5 million ounces. So really starting to charge ahead. We've got a lot of new targets. We're going to be moving into basically scoping studies this year for our large scale baseload target, and then also shifting our attention to targeting a bunch of high grade mineralization at these two neighboring projects. So essentially we've sort of baked the cake and now we're shifting to a focus on the icing. Very well capitalized to do this. We've got over $8 million worth of cash and gold and concentrates, which I'll touch upon. We monetize assets and generate revenue, which is quite helpful. But the long story short, we're in a very good position on a very strong platform. From a capital standpoint, we've got about 196 million shares outstanding, and we're sort of in that $50 million market cap Australian dollar terms. So our enterprise value is around 45 Aussie or around $30 million US for sort of North American viewers. As I mentioned, we do hold about $4 million worth of gold and concentrates, which we've just started marketing right now. We've been performing very strongly with a long track record of, I think, outperformance and progress in the market. And importantly, we have very, very strong alignment between board and management, institutional shareholders, and the rest of the register. When we think about that, the capital side, we can't forget.
Sorry to interrupt. Can you go back one slide? I had a question. Go back one slide. Yeah. Whoops. One forward.
Yep. Capital structure.
Yeah. The capital structure. Yeah. The high net worth and family office, 31%.
Yep.
Of that 31%, how much of that would you consider people that are long-term investors?
Pretty much all of it. Yeah. So that comprises people who are
that's huge,
early.
Right? 54%, insiders. That's huge. Okay, go forward. I just want to ask that question.
Yeah. So I mean, on the capital side, human capital is really important as well. As we know, it's people who make things happen. And I think what's really important to emphasize for us is we have built a team that reflects these ambitions that we have, not to be an explorer, but to be an operator. We've got our leadership team that has well over 200 years of experience exploring for permitting, financing, building, operating, and then optimizing resource assets in Australia, with a particularly strong focus in South Australia and gold. So several of our leadership team are formerly of Normandy and Newmont Mining. Of course, you guys talk a lot about gold M&A. Today, Newmont has just bought Newcrest. 22 years ago, they bought Normandy Mining, which was Australia's largest gold producer at the time, about 2 million ounces per annum. So we've got a lot of that capability in-house. We also have, the former general counsel of Santos Limited on our board. We have a mill development and optimization and operations specialist on our board. So we've got a very comprehensive team focused on this big picture. And that big picture is the objective to be South Australia's largest independent gold producer and to be producing 150,000 ounces per annum. So where we're focused on that is our Tarcoola and our Tunkillia projects, which are the two, sort of big ground position you see in the bottom right of the slide there. That's about that ground position there. These assets are about 45 miles apart from one another. So they're really kind of one project, but they're very complementary. One of them is a bunch of shallow high grade targets, and one of them is big bulk open pit. Tarcoola is high grade, Tunkillia is big bulk open pit. Together, we've got 3,000 square kilometers of ground there, over 100 kilometers of major structures. We've got over 1.4 million ounces of gold. And we're just sort of rapidly building this out. The idea is that we can actually leverage our existing mill to start a stage one operation as we now advance high grade exploration around Tarcoola, get cash flow going, and then use that to expand into Tunkillia. So the ability now, if you think about it, to break it down in two steps is quite attractive. So we've kind of baked the long-term base, kind of years 4 to 14 at Tunkillia with the resource that we got there. Now we're going to come back around, focus on infilling the high grade. That adds sort of cream to the top of that long-term production profile, but it also allows us to then bring forward production as stage one using our mill, which is processed material from Tarcoola before. So we have proven metallurgy, proven infrastructure, proven logistics, and fully licensed mill and fully licensed mining leases. The reason, thinking about that sort of staged strategy, the reason we look at Tunkillia as stage 2 is partly because, you know, that would be the development of a large new mill. So we want that to be funded by stage 1. But that is also where we can go from targeting smaller volumes of high grade ounces for high profit margin ounces, but then really shift into scale, where you're looking at big bulk open pit operations. And we actually talk about this and think about this quite carefully. And we look at Capricorn Metals as a really good example of why we care about big bulk open pit. You know, Capricorn is a company. They're about a $1.6 billion producer. They acquired a project called Carlawinda back in 2015. It was a 650,000 ounce asset, and they grew it systematically to 900,000 ounces and 1.1, 1.3, 1.5 million ounces, and then focused on bulk open pit development. Today, that is now a 2.2 million ounce asset at a 0.7 gram per ton resource, but it is Australia's lowest cost gold producer, putting out about 120,000 ounces per annum at around $1,300 Australian per ounce, or just under about $850 per ounce. So that's a really strong story to emulate, and we've essentially been following exactly the recipe that they laid out. We bought our Tunkillia asset because it had hints of the sort of the same data we saw in Carlawinda. We bought it as a 550,000 ounce asset at the beginning of 2020. We grew it to 900,000 ounces. We have found 5 new gold zones. Then we grew it to 1.1 and 1.4 million ounces, and we're getting ready to upgrade it again. So we're really playing follow the leader there. In parallel, we are also on the commercial side actually unlocking a lot of value in our installed assets. So we not only bought a mill, we bought stockpiles, we bought spare equipment. We have actually gone through a process of monetizing assets where we're on track to generate about $10 million in additional non-dilutive cash for shareholders from surplus assets and also producing gold that was in circuit in our mill. So this is something that's really, really valuable for us. When we looked at that capital structure slide, you know, we have only just a few more shares on issue than we had when we IPO'd nearly 3 years ago. So the dilution in our shares for all of the expenditure and investment and progress over the past 3 years has been about 10% versus, you know, many in the market have diluted sort of 50, 60% in that time. So that's really, really valuable. And going forward, we're going to keep scaling Tunkillia. We're going to be focusing in on high grade stuff at Tunkillia and Tarcoola, and of course, continued asset monetization. So stepping into the assets now, looking at Tunkillia, this is that asset that we've grown up, that's sort of in the vein of a potential Carlawinda. It's now a 1.4 million ounce resource. During the past several years, we've found sort of 5 new gold zones around the original footprint of the resource. And the original footprint, if you can see my highlighting there, is just where I've drawn a box on the slide. So we've confirmed a high grade zone in the middle, found all these new gold zones around them. We've converted 3 of those gold zones into new JORC resources in December. We just infilled Area 51. That's getting converted into JORC resource, we think, pretty soon. And then Area 191, we actually just published some high grade results there 2 weeks ago. And this is a bit of a fun surprise because we think of Tunkillia as big bulk open pit with high grade Tarcoola next door. But what we've got actually at Area 191 is on the other side of the shear zone. There's other stuff going on there. And we've mapped out what is now sort of understood to be a shallow high grade zone where we're actually intersecting several meters of very high grade mineralization. We had one intercept that was 3.83 meters at 68 grams per ton with visible gold. So we're going to start dialing in on that now because that is obviously very nice material to potentially have right there in your core operation. When we look at the sort of main mineralization here too, we also start to get an idea of how the geometry of this sort of a development scheduling can be quite attractive. So the main mineralization there is basically about 3 kilometers long. There's kind of 3 key characteristics there. One, the mineralization has a tendency to shallow. So about 80% of the ounces are within 200 meters from surface. 2, as I mentioned, we've identified a high grade zone through the middle. And there's a cross section of that on the right side of the screen. That zone has got mineralization that's between 80 to 100 meters wide. So this is a football field long wide, very big, very bulk style of development open pit there. But within that, there's sort of 20 to 30 meters of mineralization that grades between 2 and 10 gram per ton over this central zone. So when you're getting ready to develop a big bulk open pit, we can start right in the middle on higher grade material. And then as we're opening it to the north and to the south, this third key feature comes into play. And that's this light blue sequence you see over the top of the mineralization on the left, which is this T zone you see in the image on the right. And that is basically a shallow supergene sequence. It's between sort of 5 and 25 meters thick. It's 1 to 200 meters wide. It runs the full length of the deposit, and it has about 250,000 ounces of gold in it. So you start on a higher grade central zone, and then as you're opening it up for really bulk operations, you are getting paid to do that instead of having to fully fund that pre-strip. So that's very attractive as well. And then that combination of those two things that we're building there really represent a very small sandbox in the geology. So everything that we've looked at is in that green box on this slide. We are just starting to work our way down the shear, but we've basically got another 20 kilometers of untested shear. So we think this has really significant district scale potential over time. And hopefully in 5 more years' time, we're producing our 150,000 ounces and looking out and saying, where can we now create 250,000 ounces or 300,000 ounces per annum of production? So with that big bulk potential, you'd again love to have that high grade nearby. We've got that new Area 51 zone at Tunkillia, but just to the north, this is where we look at Tarcoola. Tarcoola is the home of high grade gold in South Australia. It is where South Australia had its gold rush on our mining lease at the same time as Western Australia. And so this is where, the old timers were there, pick shovels and a bit of dynamite and a whole lot of trouble and luck. But they were mining gold from high grade veins coming to surface at 30, 40, and 50 grams per ton. Fast forward 100 years, and a mining lease was put around one of those high grade shafts and produced around 50,000 ounces in bulk at between 3 to 4 grams per ton, which went through our mill. So there's this very, very high grade system there. And we've actually spent the last 3 years now mapping out basically the roots of that so that we can try to rapidly expand that. And the reason that's interesting is that when you look at the pit, so if you look at what has been produced there, this is a cross section of that pit you saw on the cover of the presentation. As you can see, it's very shallow. It's about 70 meters deep at its deepest point, and 5 in the northern end of the pit at its shallowest point. But there are extensions of mineralization to up to 200 meters below the pit floor. We've just started now drilling through the pit floor to put resource on there. And we've identified a brand new gold zone sitting just behind the pit wall, which we've called Perseverance West. So there's potentially a skin of attractive material on this existing open pit, walk up restart style target. And it shows you how you get this, propensity towards here, at least very shallow, very high grade structures that are easily open pitable that can act as blending feed to the big picture long-term operation, but then also bring forward stage 1 operations and start processing with our existing mill. When we think about that, now we step out and look a little bit bigger. That pit is in that sort of broader circle here labeled on the right in blue called the Perseverance, that's the Perseverance mine. That overlies this big Perseverance fault. That's sort of the feeder system for that sort of high grade zone there under the pit and around 600 historical high grade workings around it. That passes through this Tarcoola formation you can see on this slide. That's the mineralizing basin, and then it plumbs into an intrusive body, which is sort of the source of heat and pressure and fluids. What's interesting is as we look using seismic data across the 10 kilometers to the west, we've identified several analogous structures that look almost identical to that structure. They pass through the same mineralizing basin, they plumb into the same intrusive body, and more importantly, at surface, they point like arrows to targets that we'd already identified as interesting. One of which, about 10 kilometers west of the open pit, is called Warburton. That's really interesting. AngloGold drilled this in 1998. They drilled 16 meters at 3.5 grams per ton gold, essentially from surface, just under cover. They didn't follow it up because they, in 1998, the gold price was falling. And they didn't really have this same structural model. But that shows us that we've got a very interesting western bookend and a very interesting eastern bookend in terms of a little mining lease that's produced 125,000 ounces of gold at somewhere around 25 gram per ton on average. And we've got this potential field in between. And we have just now published, beg pardon, We have just spent the last 3 years converting this picture into this picture. So we now have a 3D structural model of the subsurface architecture. And we can see for the first time all of the significant historical high-grade gold expressions at surface fit consistently within this structural model. And there are multiple targets in here that actually sit undercover that have never been tested. So we've got a very exciting model to now go across and drill test this year as we get into this sort of higher grade targeting phase. For us, we have been very, very busy during the past year. We've had 2 resource upgrades. We've sold gold. We brought a bunch of new institutions in, and we're really getting ready and kicking off 2024 with the same pace that we closed 2023. We've already infilled 1 gold zone. We've already confirmed a new high-grade gold zone. We expect to have 1 or more resource updates over the coming months, including potentially 1 again quite soon at Tunkillia. And we are now shifting essentially into study phase of scoping studies or preliminary economic analysis in the Northern American terminology, while we then work out some more high-grade mineralization that we can continue to enhance those studies with. So, we're a pretty unique platform in terms of what we've got, what we're doing, who we've got doing it, and how efficiently we're doing it. And we've made ourselves pretty accessible. We've seen a lot of our share register expansion as we have moved through the past 12 to 18 months, with quite a few North American and European investors coming in now that we've got a US OTCQB and Frankfurt listing. So
Alex,
very happy to answer any questions you may have.
Can you go back a slide?
Yep.
Yeah, the scoping study, is that going to be on Tarcoola?
That'll be on Tunkillia. So that's where we've got that current 1.4 million ounce resource.
Okay.
What we're going to be doing is we sort of look at this as having baked the base of the cake. So we want to basically establish what are those baseline economics. What does this big bulk open pit approach look like while we run off and start drilling out the high grade targets that we've got, because then we can come back and add those in as enhancements and modifications of that scoping study before moving into full feasibility.
Okay, so Tunkillia is kind of a long-term project because you have to build a mill. So you're starting. It is permitted, correct? So Tunkillia is permitted all the way to production. You don't need permits on Tunkillia, correct?
So Tunkillia has got to be converted into a mining lease. So we haven't started that process yet because we want to complete the feasibility studies first. But it's the Tarcoola. Tarcoola is a fully permitted mining lease where we've got that open pit, and our mill, Central Gawler Mill here to the northwest, that is a fully permitted and fully licensed mill. So that's why we're now essentially we sort of created the long-term big picture base, and now we're building backwards. Targeting our favorite high-grade targets that can then go through that mill, step into operations using that existing infrastructure, and we can generate cash flow and then fund into Tunkillia as an expansion. Right. So it's lower risk, it's lower cost, it's lower dilution. Kind of that happy intersection of things for investors as we go forward.
So Tunkillia, since it needs a mill. So you're going to do a PEA this year. Then next year you might do a PFS, which is 25, and then maybe 25 and 26. Maybe you do permitting, and then 26. Maybe you get construction ready in 26. Is that too aggressive?
26 is probably too aggressive. So if we think about it, what we want to do is have this ticking along quickly in the background, while we're then focused on bringing up Tarcoola and the existing mill into operations. So if we think about doing a PEA or scoping study in the Australian terminology, doing additional high grade work to basically, I guess, improve the broader overall picture, getting into feasibility studies, getting the mining lease application and getting all that done, and then getting basically, as you say, development ready and getting all the finance in place. We'd hopefully be in a position to sort of look at this as sort of a four-year project to build, and then getting into commissioning, which is why we want to fill that interim gap with higher grade operations using the existing mill and high grade material that we're going to be working on drilling out now.
I started with Tunkillia because since it's your flagship. So Tarcoola is permitted, and so that one is you can move quickly on it. So, so on Tarcoola, you still, before you can move forward on Tarcoola, you still need to do some work though. You need to drill more, and you probably need to do some scoping studies on it as well. So what is your basically your plan for Tarcoola to get it into production?
That's right. So look, Tarcoola is fully permitted. We've got, proven infrastructure, proven logistics, proven metallurgy between Tarcoola and our current mill. We have really focused at Tarcoola over the past several years, essentially building this picture, because what this does is allows us to actually go out and now aggressively target repeats of that high grade pit. When we look at the pit itself, we have just done a little bit of drilling before Christmas on a part of the pit floor. We're going to come back actually starting around the end of March, come back and do some more drilling through the pit floor. We're going to do some more drilling in Perseverance West, and the idea is to try to convert, the sort of the outer boundary of the pit floor and behind the pit wall into essentially that sort of stage 1, year 1, right? So establish the toehold of that stage 1 operation, and then we'll continue to drill, deeper once we've done that. But we'll also be then looking at this field of targets. So the idea is to make sure that we are sort of systematically building this out. 2024 is going to be very heavily focused on doing this, so that 2025 we can be crystallizing the plan, crystallizing the resources, and getting it all on train for hopefully a 2026 style restart of the mill. And as you mentioned, because the open pit's fully permitted and because the mill's fully licensed, we can kind of walk up and restart as and when we please. We just want to make sure that we've got a good, strong runway so that we can go from a jog into a run with much, much lower risk, and we don't have to stop and start and stop and start.
Yeah, it's a good plan. So you're only going to have basically a burn in 24 and 25. Once you get to 26, if gold prices are up, I think they will be up in 26. You'll have enough cash flow going 26 forward to basically, other than you have to borrow money to build your mill, but other than borrowing money to build the mill, I mean, you're pretty much you're not going to be burning money after the next 2 years, right?
Correct. That's very much the plan, and that's why we were always attracted to this package of assets, is the optionality between them and the ability to stage between them. So that's very, very much the goal, and that's really kind of dominated the strategy and thinking here.
Yeah, so I look at your company as a 150,000 ounce producer long term, so it's probably going to be 28, 29. So it's a long investment. It's a 5-year investment. But after 5 years, after Tarcoola gets built at 150,000 ounces, I have your free cash flow. I have costs going up to, like right now, if you did it today, your break even would be US $1,200 to $1,300. So I'm valuing you at break even at $1,600. Maybe that's aggressive, but I think it's a good number. So at $3,000 gold, your free cash flow is around $200 million. That's what I'm valuing. That's what I'm valuing at. And so it's basically
about right.
Similar to Capricorn's valuation today, or high. I think it'll be higher. So buying it, I don't mind waiting 5 years if I'm going to get that kind of return. So yeah, you guys check all the boxes. I mean, I love your insiders. I like your board. I like your plan. A lot of people don't like these investments because it's got to wait. It's a long wait. Yeah. But I don't mind waiting. The thing that's awesome about this is that you guys aren't going to give your company away. You guys have so much potential. So your 150,000 ounces is kind of built into the cake. You use that analogy. I like it. But you guys have a lot of exploration potential on both projects, right? Both projects.
Correct.
You're not going to give it away.
Correct, right? And partly that sort of the conclusion that we're not just going to give this away reflects the kind of the staged approach, the ability, if you will, to step from developer into operations without needing to sort of give it away. And I think that comes back importantly to the point you made, is saying this is a long-term investment, but typically somebody might be looking at this and going, okay, I'm investing in a big open pit project, and I've got a 4 or 5 year horizon to get from, to get to say 150,000 ounces per annum. But the beauty of breaking this down into stages and leveraging the existing mill is, from both a risk perspective, a capital perspective, and then basically a reclassification, a re-rating of the company perspective, rather than working to jump from 0 to 150,000 ounces per annum, which requires one big shot of capital, an almighty leap from, one sort of way of being and thinking to the next way of being and operating, and a huge weight, and all the dilution attendant with that, is by leveraging the existing mill, by starting smaller, we can go actually from 0 to 20 to 50 to 150,000 ounces per annum. And we actually move into that re-rating from being the sort of pre-operator to operator sooner and with much, much lower costs. So the net benefit, all else being equal, and assuming the market is, even remotely rational, the net benefit is actually quite positive. We can make that step into operator much, much sooner without the dilution, without the risk. So that is, again, it's also part of the strategy, because then as we, to get to 150, we're not starting from 0. Which is a bigger, harder jump. So the idea is to build a pathway of value accretion as opposed to sort of intrinsic value that then has to be unlocked in one big jump.
Yeah, I haven't seen any other development project like yours that's such a slam dunk, because both of your projects are low cash cost.
Mm-hmm.
You're starting high grade open pit, and then the next one is basically shallow open pit, and so
Correct. Volumetric efficiencies of scale. Yeah.
Your capex is low in your initial project, so we don't know what the mill is going to cost, but it's a low cost project. You got everything's in place, right? There really isn't any red flags that I can see. So I really think this is a fantastic project that we shared with people. John, I'll let you finish.
Sure. Yeah, Alex, just real quickly, because we only have a few minutes. Let's see. So you have between cash and gold right now about 8 million Aussie. Is that what one of the first slides showed? So correct, yeah. Can you just walk us through, what you think you're going to need in 2024 or 2025? We're seeing some crazy numbers thrown out there due to inflation post-COVID, and so what do you see you're going to need as a company?
Yeah, look, I mean, really good question. From an operating standpoint and what we're doing on the ground, I think one of the interesting things about having done the work to kind of bake the base of the cake during the past few years is we've been very well funded, and we've been generating a lot of capital, and we're very efficient with the capital that we had and have generated. So we achieve a lot with a little. The resource upgrades that we had at Tunkillia last year, for example, we added about 413,000 ounces at an all-in cost of discovery of less than $10 US per ounce. So kind of really bottom of the cost curve discovery. But as we shift into this year and start shifting to a more, I guess, targeting the higher grade component, right? So looking for that frosting and the sprinkles to basically lay over this whole thing. That will be less and more targeted drilling. So the actual sort of capital requirement on that drilling to test the high grade premise will be a lot less than sort of like broader, expansive, major system testing and drilling. So in terms of our capital requirements, they actually come down a bit from the exploration standpoint. We'll be investing in the initial studies, but scoping studies, preliminary economic analyses are quite cheap. There's sort of $50,000 to $100,000. And we also have a head start there. We actually have data from originally a PFS done on this project back in 2013. So we've got a head start there as well. And I think to come back to your question, it bears saying that we raise capital obviously a lot internally, and we raise it externally when we kind of don't need it. We bring in value add investors. We saw this last year in June. It's the only raise we've done since our IPO, and that was really responsive to this very efficient first resource upgrade. We had a number of funds approach us and say we'd like to join you and get be part of the story. So we basically did that placement at market, in a sea of people doing massively discounted placements. So we tend to raise in little bits strategically, here and there. And, we would be hoping to, keep our external capital raising, to a minimum, in the singles of millions rather than tens of millions, to get ourselves to the point where we can say, bang, now it's time to turn on operations at our mill with Tarcoola. And of course, when we want to take that step, we have the unique advantage that having an existing mill that is installed commercializable infrastructure that we can monetize. So we can actually look at debt for that as opposed to an equity solution.
Okay, great answer. You know what? We're gonna sign off with you here, if you don't mind, Alex, and then Don and I will kind of go through some of your comments for the listeners, and we'd love to have you on again either later this year or in 2025. Go ahead, Don.
Yeah, I had one question about Tarcoola. So
Yep.
There's no refurbishing on the mill. It's ready to go.
So that mill, we'd actually would look to do a bit of an optimization. So we actually took down the gravity circuit because we realized that there may be an opportunity to improve further the gravity recoveries. And taking that down is where we came up with about 15 tons of high grade material that now forms this sort of $4 million in concentrates.
Do you have an estimate on the capex for refurbishing it?
I think, outside conservative estimate, we might look at investing 10 Aussie into the mill to basically optimize it and get it running. Again, we can break that down into different parts.
And there's no leach pad, right?
No leach pad. So it's a gold circuit going into a CIP leaching circuit. Yeah. And then your tails go off. We've got a fully permitted tailings facility.
10 million Aussie is nothing for a capex, right? So it's easy.
Right. Okay. Correct. Yeah.
Beautiful. Loved it. Alex, that was awesome. Thanks so much for sharing.
Well, thank you guys very much for having me. I'll leave you to it.
All right. We'll see you.
Thanks, Alex.
See ya.
Yeah, Don, great recommendation there.
I can't find any red flags on this thing. It's a beautiful story across the board.
Yeah, he answered all our questions. I thought he did a great job, not only walking through the story, but addressing, any questions we came up with. Obviously, the biggest overhang on so many of these names now is near-term cash and having a game plan like you talked about on our last one. Right. And they clearly have both of those things figured out. But then the capex thing is something that I'm always concerned with because we keep seeing those numbers go up. So 10 million Aussie is nothing, for infrastructure.
Yeah, and they're going to produce 30,000 ounces a year on that open pit or more, depending on the grade. But it's going to be at least 30,000 ounces a year. That alone is going to fund their preparation, if you will, for Tarcoola. So they're not going to be burning anymore. So there's not going to be, from the capex cash requirement standpoint, and it's not an issue at all for them. And like you said, that's one of the biggest hurdles right now for development stories. They don't have to do any permitting for Tarcoola, and it's a district, it's a mining district. So Tarcoola is going to have no problem, I think, getting permitted. They just have to go through the hoops. But South Australia is not known for problems with permitting. It's like I said, it is a district. There's been a lot of gold mining in that area. As a matter of fact, when I heard this story, I was like, wow, I got to buy that stock. That thing, that looks, it just checks all the boxes that I look for. Now, some investors are like, I don't want to wait till 2028, 2029 to get paid. It's too long, Don. I'm not waiting. And really, that's what this story is. You're not going to get paid for 4 years,
It's possible, though, because, remember 2020, right? I mean, I had very intelligent clients just Google searching gold stocks and pulling, buying whatever was coming into the field. I mean, I remember there was Free Gold Resources or Ventures, which was a stock at 3 cents on the low side that got written up by Eric Sprott, and then the thing went to $1.30. And I had clients asking me, why did I miss this? And I'm like, because there's nothing. I mean, there's something there, but there's not a lot there. I'm not going to chase something from 3 cents to $1.30, guys. So it's like you could have a euphoric move in a lot of gold names, and I like that they're pure gold.
yeah, if sentiment comes back, you could see stocks like this take off in anticipation, right? Yeah,
Yes.
we back in the early 2000s we saw that. We saw these companies, they had a deposit and boom, there goes the stock. So
Right.
it could happen again, but my anticipation is to get your 10 bagger, you're gonna have to wait 4 years, but you could get a 3, 4, 5 bagger. I mean, that's a possibility if sentiment comes back. But the big money is when they get that 150 into production. That's when the
Yep.
big money comes. That's when this thing flies over $1 billion. So yeah. So, but I time flies. I don't mind wait. I don't mind waiting that long for that kind of return. So all right, you're out of time, John. But
Yes,
I
man.
think that was one of our better uh, interviews, if you will.
Sure.
That was great.
Very solid, and I appreciate you suggesting that, Don. So why don't we leave it there, and we'll be back next month interviewing some other companies that have a lot of interest as well. I think we're really close to determining who that will be here late March.
Yeah.
But until then, you and I will see each other locally, and
Yes.
I appreciate you as always coming on and sharing your thoughts. So this is John Feneck with the Feneck Commodities Report, and signing off.
All right, John.
Take care, guys.
Bye bye.